Okay, so this video is going to be something that I'm putting together for my brother. I might release this, I don't know, or it might just end up being something that I use just for my Patreons and just for anybody that is on that level that wants to get a little bit more insight into how I research companies, how I do all my investing. Basically, I'm going to go in depth into all of that stuff because I was talking to my little brother and we were trying to decipher how to make investments, and I was just telling him everything, and he was like, whoa, that's a lot of information. So I was like, you know what, I'm gonna put an entire video together. The editing is gonna be sloppy in this video already. The voice commentary is already trash. The point is, this is gonna be a very long video, but it's going to have everything that I know about investing in one place, so that anytime anybody asks me anything, I can send them this video link and they can check it out. It's not going to be clean. It's not going to be neat. It's not going to have a thumbnail. It's not going to have any of the YouTube stuff that keeps people watching. This is for only those people that is really interested in learning how to either invest passively or invest in single stocks. So that's the focus. So the first thing is, when it comes to investing, the most important thing that we have to keep in mind is you have to determine what kind of investor you are. And by the way, we're not going to talk about anything personal finance. We're not going to focus on that. At this point, if you're watching this video, because this was directed towards my brother, I know where he is in his personal finance journey. And so I'm assuming that you are at the point in your personal finance journey where you can actually start investing. So I'm not going to talk about all the other stuff. So at this point, when it comes to investing, there are two things that there are two types of investors. There is the passive investor, and then there's an active investor. So a passive investor is basically what I do when I don't want to think about my investments. Passive investing is when you invest in things like ETFs, index funds, and those kind of things where you're not really thinking too much. You're not trying to time the market. You're not trying to find a good entry point. You're just investing for the long haul. And I think for most of us, myself included, most of us, we should be passive investors where we're just dollar cost averaging into an ETF or dollar cost averaging into an index. Most of us, if you have a 401k, you're a passive investor. In 401ks, most of the things that you have access to are mainly index funds. And so I'm going to go through what you should be looking for when you're looking at ETFs and index funds if you're building out a portfolio. And just a few items that is very important. If you don't look for these items, it can end up biting you in the butt. If you're not doing this in a 401k and you're doing this in just a brokerage account, we're also going to look at that as well. And then the other type of investor is an active investor. These are people that are trying to pick single stocks. They're trying to make more out of investing. They're trying to figure out to become like a Warren Buffett type of person. They're trying to get the best out of single stocks because you can do better when you just pick single companies that are going to do well in the long term. So the second part of this video is going to be focused on active investors, but we're going to start off with passive investing. And the one thing that I want everybody to keep in mind when it comes to passive investing is simply, once you start, you don't stop. Once you start, until you retire and you decide I don't want to invest anymore, you do not stop passively investing. Passive investing starts off with you just setting an amount that you're going to invest every single month or every single week, whatever you want to set it at. For example, in my Robinhood portfolio, if we go into my Robinhood, I'm going to share my screen. In my Robinhood portfolio, I've shown this portfolio multiple times for those of you who follow the YouTube channel. In my Robinhood portfolio, I have an ETF in here called SCHD. Every 2 weeks, I put $50 into this ETF. It doesn't matter if it's up. It doesn't matter if it's down, because I believe that in the long run, this is going to be good for me. That's why I do it. Because when it comes to passively investing, you're not trying to time the market at all. You're not trying to find when it's at the bottom. You're not trying to find the intrinsic whatever about an ETF or anything like that. However, there's a distinction of the different types of ETF. There are passively managed ETFs, and then there are actively managed ETFs and index funds. The difference is basically the amount of fees you're going to pay on either one. So just to break that down and to give everybody an idea of what we're talking about when we say active versus passive, I'm going to go to my favorite site to look up anything with ETFs, ETF.com. And basically I can search for any ETF. So we're just going to bring up the ETF that I was just looking at, SCHD. And basically, by the amount of fees you pay, the expense ratio of that ETF, this is how much the manager of that account or the manager of this fund is going to take for managing this fund. As you can see right here, it's a 0.06%. Now, for most people, they're going to be like, oh, that's not that bad. And if I bring up everybody's other favorite ETF right now, which is stupid expensive, let's just bring up ARK, this is everybody's favorite ETF right now. Everybody's praising ARK. But if we look at the expense ratio of ARK ETF, it's 0.75. That's a big difference. If we go, let's just say, let's go into, I like to use investor.gov to calculate like interest, to do my compound interest calculation. And we're just going to say, like, let's say you have an initial investment of $10,000. You're investing $500 every month after that. And this is over a 10-year period. And your interest, your return, we'll use my favorite ETF to use for everything is VOO, which is the S&P 500. And the S&P 500 has increased in the last 15 years, it's gone up 15% year over year. Yeah, in the last 10 years, the S&P 500 has gone up 14%. Actually, if we go to SCHD, we'll just use SCHD as my barometer. So SCHD in the last 10 years, it hasn't been around for 10 years. So we'll just say in the last 5 years, SCHD has gone up 16.7%. So we'll say with an active return of 16.74%, and your variance based on the fees is 0.06, right? 0.06 is the variance. And we calculate that, we'll see what we would have earned over a 10-year period if we just invested in this fund. And over that period of time, you would have taken $10,000 and made it into $179,665, right? If you were getting 16% year over year. But then if you look at the variance, if we look at the variance of 0.6%, without the fee of 0.6%, we're just going to look at the bottom number. The bottom number is $179,034.62 compared to what it would have been, which is $179,665, right? So that's you can see how minimal that makes a difference. However, if we compare this to ARK Invest, and we say we invest in $10,000 and we're contributing $500 every month after that over a 10-year span. And for ARK Invest, ARK Invest has done really well in the last few years. In the last 5 years, it has compounded 46%. So if we say 46% compounding, the variance is 0.75, and we calculate. You can see of course, it made way more money, which is $1 million. But however, look at how much the fees cut into how much you could have made. So you could have made $1,001,046, versus because ARK is going to take their fees, you would have only made $958,000. So $100,000 gone. $100,000, or actually $50,000 gone. Just from that little, it looks small, 0.75% in fees looks very tiny. But the other thing is that so that's something you have to take in consideration. So the thing is, with actively managed ETFs like ARK Invest, which has a higher expense ratio, you're going to be paying higher expense ratios. But the problem is you also don't know exactly where this is going to go because it's actively managed. You can't track it for real. Like, you can look and say, okay, over the last 5 years it's done well, but I can't predict how it's going to be in the future. I mean, right now in the last 3 months, it's down 13%. If we compare that to SCHD, it's up 16%. So it's harder to manage an actively managed ETF. So I try to avoid all my actively managed ETFs. It's because if I'm trying to invest and forget about it, I'm not trying to pay attention to the daily movements. I'm not trying to pay attention to how everything is doing. When you're a passive investor, you're not trying to pay attention to anything. You're just doing it. Basically, you're putting the money in and you're acting like it doesn't even exist anymore. And so I would advise that if you're trying to be a passive investor, do not do actively managed funds. And the easiest way to know more about a fund, if you hear about an ETF from somebody, let's say somebody was like, yo, ARK is the greatest thing that comes to mind. If you're trying to figure out, is this an actively managed ETF or is this a passively managed ETF, go to ETF.com and just read about the fund. The first line says right here, ARK is an actively managed fund that seeks long-term capital growth from companies globally involved with or that benefit from disruptive innovation. So up front, they're telling you like, yo, we're going to be buying, we're going to be selling. and we're going to be making moves in and out of this fund. What that means for you is you're going to be paying a lot of tax. You're going to be paying, your fee is going to be higher because you're paying more from taxes. You're going to be paying a lot more because they're buying and they're selling. They're buying and they're selling. Where on the other hand, we can look at SCHD, and SCHD first line. SCHD tracks a market cap weighted index of 100 dividend paying US equities. Simple. Very simple. I advise that if you're trying to be a passive investor, if you're trying to not be actively in the market and try to pay attention to like, oh, what's going up, what's not going up, I advise that you just start with literally doing a passively managed ETF. And the ultimate one to start with is VOO, which is the S&P 500 ETF. It's literally one of the best ones that you can just do. And you can do it and forget about it. It's literally, you just put your money in and you forget about it. I advise that the three that I'll advise everybody to go with is VOO, as you can see on the screen. QQQ, which I'm not the biggest fan of QQQ because QQQ has a higher expense ratio at 0.2%, but it's still not that bad. But QQQ, and then finally, the last one that I would advise if you're trying to do active investing is SCHD. Mainly because SCHD is focused on dividends. So if you want income as well, so SCHD, if you just want growth, you want that thing to keep growing for you, I would go VOO. And then also, actually, the three that I would say everybody should get is VOO, VTI, and QQQ. So VOO is the S&P 500. QQQ is the NASDAQ 100, the 100 biggest companies in NASDAQ, which is a lot more tech focused. But it has more risk as well because the NASDAQ is very volatile compared to VOO. And then the last one is VTI. VTI, it just is the total market. So it has other companies that VOO may not have in it. I really like both of these. Both of them have expense ratios that are 0.03%. So you're paying basically nothing for pretty good return. Over the last 10 years, this has returned almost 14%. It's not bad. So if you're trying to just put some money away and just do it over time, I definitely will advise you to go to something like VOO, VTI, or QQQ. So that's passive investing. Passive investing, you have to pay attention to the fees. You have to pay attention to how the fund is being managed. Is it active or is it passive? That tells you how much you're going to be paying in fees. So VOO, VTI, and QQQ are the three that I'll recommend for anybody to get started with. So that's passive investing. Now let's go into active investing. Active investing is you trying to pick single stocks. Is you trying to figure out which stock should I go with? Which stock is the stock that I should pick from? When should I buy that stock? All that stuff. And like my brother, we were talking about it. And the thing we were coming down to is for a lot of us, you're going to want to be very selective about the companies that you're investing in. And to get the best returns, in order to have the best bang for your buck, you're going to have to be very, 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 very narrow. What do I mean by this? What I mean is it's better for you to have, I'll say if you have under $10,000 invested, or if you have $10,000 in your hand, you shouldn't have more than like 10 companies. In fact, you shouldn't have more than 5 companies if you only have $10,000 that you're investing. I'm learning that the hard way. Because otherwise you're cutting into your potential returns. Because you want to be as narrow as possible. So at most 5 companies to start off with. When you only have like less than $10,000 invested, 5 companies. Pick 5 companies that you absolutely love. But even then, you have to ask yourself a few questions. The first question that you got to ask yourself is, what does this company do? Do you understand the company that you're about to invest in? Because a lot of us are just kind of following the trends of like, oh, this company, somebody was talking about it. Oh, I heard about that guy talking about this company. Oh, this company has done well. No. Do you understand what that company does? For example, one of my favorite companies of all time, Microsoft. I talk about them a lot on the channel because that's one of my favorite companies to invest in. I've studied them a lot. I understand a lot about the way that Microsoft makes its money. I understand a lot about the competition of Microsoft. That is just as important as understanding the company. And the easiest way to learn more about a company is you can go to seekingalpha.com, which is one of the sites that I use to find out more information. And if I was trying to learn more about Microsoft, what I'm going to look for is something called their 10K report. So what you can do is go to Seeking Alpha, go to financials, Go to SEC filings. If this wants to load, and then you can look for their 10K report if this wants to show it, which is their annual report. Every year, companies have to file an annual report about everything that happened in the year prior, right? And so you want to go to their 10K report and read up about the company. The other way you can find this is just to search Microsoft 10K. Boom, and it will take you directly to the site, directly to the company's website, and gives you that 10K filing, where you can read up about the company. I just like using Seeking Alpha just because it's multiple companies in one place. I don't have to go searching for it. And the main things that you're looking up when you first get started investing is, if you don't know much about the company, the first thing you're gonna look up is just click the business. And this is gonna take you down to the business section of that 10K filing, and you can read about what that company is about. For example, Microsoft is a technological company whose mission is to empower every person and every organization on the planet to achieve more. We strive to create local opportunity, growth, impact in every country around the world. Our platforms and tools help drive small business productivity, large business competitiveness, and public sector efficiency. You can read that whole thing, but whatever. That's not important. The one you're going to look at is like what we offer. Founded in 1974, we develop, support software, services, devices, and solutions that deliver new value. And it's like, okay, so how do you deliver those values? Their products. It includes operating systems, cross-device application, server applications, business solution applications, desktop and server management tools, software development tools, and video games. We also design, manufacture, and sell devices. So basically, this tells me every way that Microsoft makes their money. Every single way that Microsoft makes their money. Very important. Now that I have that background, what you can do is you can keep going down the line of understanding this business. Okay, that's how they make their money. What is it that gives them their competitive advantage? Which we'll talk about that in a little bit. But basically, it then breaks down like how they make their money. Cloud. So it talks about their intelligent cloud and intelligent edge platform. And then it talks about talks about personal computing. And then it talks about their future opportunities for growth, which is very important to read about. And then from there, then you keep on reading and reading and reading. Some of this stuff you can ignore. For example, COVID-19, I don't really care. You see, COVID-19 is very specific to 2020. This was not in here when I looked at their 2019 10K report, but it's important for them to notice. They're talking about racial injustice, which is key for them. That's important for me. It may not be important for you, but it's important for me to see what they're doing towards that. I want to put my money towards companies that are actually like going to further the good of mankind rather than just destroy our planet or destroy human beings and those kind of things. So that's important for me. And then you keep on reading and you start understanding like, okay, this is their operating segments. These are all the things that bring them money. So you read about that. It's like, okay, they have business and productivity and business services. What does that mean? Office 365. And then you look at Office Commercial, Office Consumer. So two different products. One is for businesses, one is for you and I. And then you see, okay, LinkedIn is a big part of your business. Dynamics, what does that mean? CRM, something for businesses, consumer relationship type of stuff. And then you keep on going. And then this is very important. Competition. This section is very important. Competition, because this tells you if this company is one that can be easily challenged or if they have, question number 2, does this company have a moat? Does this company have a competitive advantage? Is there something about this company that is going to help it to stand out? Is there something about this company that is going to help it to compete and make sure that other people do not come against it? Let me just explain, like when I talk about moat. In the old days, when you were fighting a war, you wanted to build something like this. You wanted a drawbridge where there was only one way in and one way out, where you can easily challenge your competition, where you can easily take control, make sure everybody's protected, and then make sure that your castle doesn't get destroyed. That is a moat. It is a defensible, advantageous position for a business to be in. That's what you're looking for when you're looking at good businesses. You're looking at what is it that is special about this business. In Microsoft's case, Microsoft has been around for so long and it has such a wide moat when it comes to enterprise solutions that it's hard for other competitors. As a matter of fact, we had Slack, who actually filed an antitrust lawsuit the moment Microsoft launched Teams. Why? Because Microsoft is that competitive. It's hard to play against Microsoft. Microsoft tried to buy Slack. Slack said no. Microsoft launched his own product. Everybody got mad, or Slack got mad about that. My point is, what is the competitive advantage of this business that you're about to invest in? And then how are other people competing against it? In this example, you look at the examples of competition that Microsoft has. Apple, Cisco, Facebook, Google, IBM, Okta, Proofpoint, Slack, Symantec, Zoom, and numerous other people that can be competitions against it. How is Microsoft going to be able to stand out against each and every single one of these companies? Very important that you understand, what is this company doing? What is its competitive advantage that this company has? What is the competitive advantage that this company has? Very important that you understand both of those things, because if you do not understand both of these things, it's going to hamper you. Most of the time, this is where people get caught up, because there's a new technology or there's something new. Like, for example, if you look at the EV space, there are so many different EV manufacturers now. We have Lucid Motors. We have Tesla, of course. We have what's another? NIO. We have Rivian. You have all these different manufacturers, but the question is, like, what is their competitive advantage? What is it that's going to make this company do well in the global stage? And the other problem that a lot of these EV markets, this is just an aside, EV companies have, is they're also competing against legacy car manufacturers. That's also something you have to think about, is legacy car manufacturers like Ford, GM, Volkswagen, and all these other companies are not just going to be like, oh yeah, you know what, we're not going to try and compete. We're not going to make electric cars. No, they want to make money too. So how is this new company going to make a pace or break a market out for itself? For example, Tesla was able to do that. Tesla was able to do that because it was one of the first, and then it built out an infrastructure. That's one of the biggest reasons Tesla has a moat, is its infrastructure is so massive. And then moat number 2 is augmented driving, because basically Tesla is a computer on wheels. That's the other moat that Tesla has. Do any of these other EVs have some kind of competitive advantage? I don't know. You have to ask yourself that question. What is it that makes this company special? Do not just ride with the hype. Do not just ride with what everybody else is doing or with what's going on in the current market. Because in the long term, you always have to think about it like this. In the short term, the stock market is a voting machine. In other words, people are going to be jumping in like, oh, this is the way we think it's going to go. This is the way we think it's going to go. But in the long term, the stock market is a weigh-in machine. In other words, it comes down to your cash flow. It comes down to, are you making money? Are you making a profit? Are you making something that people are going to use? You got to ask yourself these questions. So the last question, the third question you got to ask, is a harder one to distinguish. And that question is, what is the management team like? For this one, you have to listen to earnings calls. You have to listen to interviews that the CEO is on. You have to hear how they're talking about the company. You have to listen to how they're running the business. So one of the things that I like to use is a website called quickfs.net. On quickfs.net, it does a quick breakdown of a lot of different measurables for you to be able to understand businesses. But the number that you're looking for when you're looking at management, for a quick, like a lot of this stuff that I'm talking about is a quick look into the business. For a quick look into the business, you're looking for return on equity. Return on equity. As a shareholder, it is important that you understand how this company is using the money that you're investing in them. You have to understand, is this company doing really well or doing really badly with it? Now, on the other side of this is, if you're looking for newly found companies, their return on equity is going to be trash. It's going to look terrible because they're just getting established. You're looking at return on equity and return on invested capital over a 10-year period if you're looking at an established business. New companies, it's going to be extremely hard to see that, which is why it's a lot easier to value older companies and companies that already have cash flow. So you can see in this QuickFS site, it can give you a quick breakdown of how to look at return on equity. However, if you're looking at companies that are just getting started, for example, you're looking at companies like right now, one of my favorite companies that I keep looking at is Roblox. Roblox has a trash return on equity. However, I'm looking at the competitive advantage of that business. And I'm also listening to how the CEO talks about the business. I'm also listening to how the CFO talks about the business. I'm also listening to how everyone talks about the business. I'm trying to find every single interview that I can find of the leadership of that company, because how he speaks about the business is how he's going to implement things in the business. It's very important that you listen and then see their action afterwards. It's like, okay, I heard you say this. What are you doing about that? Read the shareholder letters. Read the letters to shareholders that the CEO is going to put out. Read all that information. It's a lot of work to pick single stocks. It's not something where you just, oh, I think that company is going to be good, and then you roll with it. So that's the third question. The final question you got to ask yourself is, what is the valuation of this business? This is the hardest question to answer most of the time, because a lot of the time you have a company that you really like. It has a good business. It has a competitive advantage. The management is solid, but then you have to decipher what is the value of this business. Valuation is important because even a great business can be a terrible investment. If you buy a business when it's at all-time highs, is it possible that it's going to climb higher? Is it possible? Or is it just going to crash? That's something that we always have to think about. Of when I invest in this business, is this business going to grow or is it just going to stagnate? Even if this, and the other question you got to ask is, even if this business grows, is it that the market has jumped so far ahead of the business that it's going to hold it back? For example, Microsoft, if we go to just looking at Microsoft's share price in the last decade, or actually in the last 2 decades, we'll just say max. Microsoft during the dot-com bubble was at an all-time high of $58.75. It took Microsoft almost 20 years for it to get back to the same position. 20 years for you to see any kind of return on your investment. So even a good business, even a great business, Microsoft, and during that time, if we look at Microsoft's earnings, actually, you can't go that far back because I'm not paying for the full thing, but Microsoft was making money. It was growing. It was doing really well. However, because people overpaid for it back in 99, it took 20 plus years for it to come, or 10 plus years for it to come back to being where it is today. So it's very important we keep that in mind. Even a great business can be a trash investment. So how exactly do we value companies? There's a lot of different metrics. There's the PE ratio that can be used. There's the price to book ratio. There's all this kind of different measurements that people use to try to get like a quick access of a business, especially when it's a newer company. It's hard to value them. Like I said earlier, newer companies are hard to put metrics on because they're just getting started. But for established companies like Microsoft, the way I like to do is something called discounted cash flows. Basically, I'm looking at how much cash that they're producing, and I'm discounting it back to this point in time. I'm discounting it back to where they are today. So as you can see, I've done a lot of them on a lot of different companies, but we're just going to look at Microsoft today. Just so we can have something to look at as an example for this. So the key points in this example, this PowerPoint and this Excel sheet was something that I found from somebody else, but it put it down together in a very easy and understandable way that I could put it in. So basically it has some steps down here of how you want to fill this out. But basically what you're looking at is, first you start off with when is the first year you're projecting it, the company ticker, and then what is the required rate of return that you expect to have on this investment. For me, my required rate of return is year over year, I want a 10% return. I want a 10% return from my investment. And then now you start filling out all the information that you can get online. So one of the websites that I love to use for doing all of this is Yahoo Finance. So if I just go to Yahoo Finance real quick, Yahoo Finance is one of my sites to get information from. It's easy. I can see most of the stuff that's on there. Let's go to Microsoft. Come on, Yahoo. Actually, you know what? Bump that noise. We have Microsoft down here. You go to Microsoft, and then we just start looking at statistics. So you click on the statistics bar, and then you can start filling out some information. So the first information it asked was the shares outstanding. Shares outstanding is the first information it's asking for. In Yahoo Finance, you can literally just go to statistics and get the amount that you need right there. Very straightforward, very simple, very easy to use. And then after that, it's asked you to get a lot, your perpetual growth. So growth rate. For really good businesses, your growth rate, and really new businesses, growth rate is going to be about 3%. But for businesses that have been around for a long time, about 2%. Because it's extremely hard to grow an established business. It's a lot easier to grow a smaller business. This number is something I still don't really understand it. I'm gonna be honest with y'all. A lot of the stuff that I've learned, I don't fully understand it, but I understand it just enough to be able to get me started. So growth rate is gonna be about 2 to 3%. If it's a new business, like for example Lemonade or Roblox, I'm gonna put 3% because it should be growing extremely fast. For an established business but still a great business like Microsoft, I put 2.5%. Then the market cap. Just make sure when you're putting in these numbers, make sure you're putting in the right way. So Microsoft is a $1 trillion company. The numbers in here are supposed to be in billions. So I had to put this as 1,717. Let me see. Yeah, 1,717, which is the number that I use for their market cap. If you look up here, the market cap right now is 1,000. If you look up here, the market cap right now is 1,777. So when I did this, I was looking at them. They had a 1,717 trillion market cap or billion market cap. And then for the numbers, as far as cash flow and operations, the site that I love to use for this is Morningstar.com. Morningstar.com. If you go to Morningstar.com and you search, let's just search Microsoft. Come on, it brings it up. And then what I'm going to do is go to, if it loads, come on, load. Okay, I'm going to click on key ratios. I'm going to go to full key ratios. And then I'm going to go to financials. And then in financials, you can start finding the numbers you need. So the first one that we're looking at is we're looking at the cash flow statement. So cash flow statement is basically telling you like the balance, all the money, it's like they say, you can play around with all the other numbers, but at the end of the day, cash is king. So cash flow is the first thing that I look at. You can click there, and then you can just gather all the information you need. So the first thing it's going to ask you is your total cash from operating activities. Total cash from operating activities is over here. Or the easier way to take all these numbers is just look at the bottom numbers. So these four numbers is what you're trying to figure out. Is cash from operating activities, capital expenditure, how much are they investing back in the business, and then free cash flow. So if we go back in here, these are the three numbers that you copy and paste from in here. So you go from there, and then the next one is your income statement. So for that, I would just go over to income statement, and in the income statement, that's the revenue. The revenue is the total amount of money that a company makes. This is the money that they bring in. Think of it as your gross pay. Like before you have to pay taxes and pay all your bills and you have any money to be able to spend as you like, you have your income that you're paying, your salary before tax, your gross pay. In the same way, revenue is the same thing. So their gross revenue is right here. You take this number. My camera keeps dying, so it's fine. We'll keep going. You take gross number, which is this up here. But notice in the Excel sheet, we only have 4 numbers because we're only going back 4 years, which is not a bad idea. It's a good way to get you started and get an average idea. Remember, investing is not a science. It's not specific. It's not particular. It's more of an art. You have to just know it's an art form. So everybody's very flexible with it. So you get your revenue, interest expense. If we go back in here, interest expense is right here. It's all these numbers. And then the next one it asks you is interest before tax. That's this number, income before taxes. Or actually, it says interest before taxes. I skipped one. So interest before taxes is this other income expense right here. So it's that number. And then after that, you have income before taxes. That's the next line right there. It's pretty straightforward. Income, net income, all this stuff is pretty straightforward. So you have net income and all that stuff. And then it has one other number, income tax expense. Income tax expense is, where is it at? Right there. Yeah, these are the same, by the way, in this situation. These were the same numbers. So after that, you have your net profit margins. And the good thing about filling out this entire document is then you get a more understanding of the financial position of the company. Then you can be like, oh, Microsoft, they're in a pretty good place. By the way, net profit margin, you want it to be about I think between the range, if it's above 10%, that's pretty good. If it's above 20%, that's amazing. 10% is good, 20% amazing. And then finally, you want to look at their balance sheet. How much in debt is this company? Because just like you and I know, we ain't trying to be in debt. So you want to see, is this company in a good position financially or in a horrible position financially? So what you want to do is also in here, it's going to ask you for total liabilities, total current liabilities. Current liabilities means liabilities or debt that they've taken on in the last year. And total current asset is debt that is cash that they have on from the last year. So in this situation, total current liabilities is this line right here. You would take all those numbers and fill it in right there. And then total long-term debt. Long-term debt is also important. You have those numbers right there. And then cash, of course, in this case, it just wants from the last year, from the most recent balance sheet. So in this situation, total cash from the most recent. Microsoft is very cash heavy. It's one of the reasons that I like Microsoft. And then after you input all these numbers, the second part of it is now determining how long do you want to forecast. So in this situation, I wanted to forecast it for 10 years. I wanted to use free cash flow as my calculation. You cannot do a free cash flow calculation on a business that's not generating any cash. It's extremely hard to do. There are other options on here, but I choose to just do a free cash flow calculation. And then I don't have any projections, so that's fine. It's going to populate this part of the screen. And then as far as growth rate, if you're not sure, a cheat that I like to use is on Yahoo Finance, because Microsoft has a bunch of analysts that follow the company. I just go based off of the growth estimates that Yahoo Finance has. So Yahoo is expecting that in the next 5 years, Microsoft will grow about 16%. And then you can either come up with your own growth rate based on all the stuff that you know about a company, but that's also a good point. I cut back based on what Yahoo says. I always take more of a defensive approach. And so I'll be like, okay, that's cool for Yahoo Finance, but I personally need this number to be a little bit less, right? So I started off with 15% growth rate for 2021, and I expect that number to dwindle over time. So I went 15% and all the way to 10% in 10 years from now. I believe Microsoft will still be growing at about a 10% growth rate. So you come into this tab, and this will populate. It will populate all this information for you. So now, based off of all the information that we've put in, now we can determine how much is a fair value for me to pay for Microsoft shares today. Based off of my calculations, Microsoft is extremely overvalued because it is trading at about, let's go up here, $231 versus what I calculated to be $185. So fair value for Microsoft is $185. It is not trading at that. But even on top of this, let's say Microsoft was trading at about $185. That does not mean I should go ahead and buy them unless I just want no margin of safety. Margin of safety is basically like, even if this stock falls, I'm good because I'm going to buy it at a much cheaper discounted rate. Basically, margin of safety is you want to get a discount on any stock that you buy. So yeah, so Microsoft right now is way over the top of this. So it means that you should probably not be buying Microsoft based off of this calculation. But again, this whole thing is based off of assumptions that I'm making. In other words, it is magic. Not real, it's magical, and it's fairy dust. So everybody has a different way that they do this. This is just the way that I do it for large companies. But yeah, that's all I got. Hope this helps if you're trying to get started investing.